Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome back to Module 4, Forex Expert, Lesson 3, Forex Seasonality. This is the agenda for today. At first, we will talk about seasonality, what it is, and how we use it as an additional zone qualifier. Then we will look at examples like the Mexican peso. Yes, the Mexican peso is very seasonal. Also, in this lesson, we will put it all together: supply and demand, commodity correlations, and seasonality. So we will look at crude oil and the loonie, gold and silver, which is my favorite seasonality of the year, and gold and the Aussie. This is a very long lesson, so at the end, I'm going to give you a little bit of a summary. Seasonality is another great additional asset class specific zone qualifier. It's really a window of opportunity. It's a period of time that reflects a statistically favorable time to position ourselves in a certain way, either long or short. It gives us a macro bias in the market. Seasonality can be positive during a certain period, meaning we would be macro bullish, or it can be negative, meaning we would be macro bearish. So in other words, when we go into a seasonal trade, we have a statistical probability of being right in our trade. Generally, a good statistical probability is 80% or higher, looking at the past 15 years. 80% seasonal probability over a period of 15 years means that 12 out of 15 years, a product is either bullish or bearish during a specific time frame. In some futures markets, there are even seasonal setups that can have 100% over the past 15 years. So 15 out of 15 years. Sugar is a good example for that, as it drops from March to May. The amazing dynamics here is that seasonality happens year after year. So once we become good at it, really good at it, it can give us a yearly roadmap on what markets to focus on during a specific time of year. For example, January to April, long gold and silver, and therefore also the currencies that are strongly correlated with gold, like Aussie long or USD JPY short. From March to May, we would be looking to short sugar, and so on and forth. Therefore, seasonality can help us to choose the right trades, where we have the best probability of success. This is going to be especially important once you scale up your business and risk higher amounts of capital per trade. The higher the amount you risk, the lower the amount of trades per year, and therefore, the more you have to focus on probability of success. Seasonality works really great for all income goals, even daily and weekly income trades, where we may be looking to hold trades for a couple of weeks. However, the most powerful seasonal patterns are longer term ones. Today, I will show you the most powerful ones, but I will also show you how to generally look at seasonality so you can use this as a zone qualifier also on your own trades and for your own analysis. So in the world of futures, seasonality works great because we are really talking about commodities, which are cultivated and therefore depend on seasonality in terms of weather, like soybeans, corn or coffee beans, but also cattle or the demand for crude oil or heating oil would be weather dependent. In Forex, we also have Forex specific seasonal patterns. However, I have found that they work best when you combine them with one of the commodities that are highly correlated and map those to the currencies. So for example, not just looking at the seasonality of the loonie, but also the one of crude oil. Really using what you've just learned in the previous lesson and combining correlations and seasonality. So we have these seasonal averages or seasonal patterns, and they should be shown to be relevant over long periods of time. They can be 5 years, 10 years or more, 15 years, or even higher, like 20 or 30 years. In general, the longer the seasonal pattern has been shown to be relevant, the more powerful it is. That's just due to statistical reasons, right? With the sample size being bigger and therefore the probability of success is more accurate. However, 30 years is really the max we want to be going back in history. That's just because technology and the monetary system are constantly changing. The financial market is very different than it was 50 years ago, right? So, as a rule of thumb, we're going to be looking at seasonal averages and seasonal patterns that have been compiled from 5 to 30 years. And then we would look at the different seasonal patterns and compare them, because you might see some seasonal evolution going on. So you would look at the past 5 years and compare it to the past 15 years and the past 30 years. And if those patterns are aligned, you have a pretty good seasonality on your hands. Now, seasonality works great because commercial traders, big traders, are aware of seasonal trading and these seasonal tendencies. Why? Well, because they are in that business. For example, if you work for a coffee company like Starbucks or an oil company, a gasoline company, if you work in the hotel industry or an airline company, and your business is dependent on a specific commodity, you're going to know seasonal fluctuations of that commodity and buy when prices are low and sell when they are high. Okay, I get it. Now you may be asking rightfully, well, why is it that retail traders are not aware of these seasonal patterns? Well, that's a really good question and difficult to answer from my perspective, because for me it's normal to look at seasonality. One of the reasons is that retail traders simply don't know about it. And even if they did, they do not know how to time these markets or these patterns. Most importantly, retail traders are usually not mid to long-term investors. They might be more focused on day trading kind of trades, intraday trading. And therefore, retail traders simply ignore seasonal trends. And that's really a shame, because you get some really nice moves with seasonality. Now I want you to write down the following. Just because there's a seasonal pattern doesn't mean we're going to blindly buy or sell. Seasonality does not give us the license to take trades we otherwise would have not taken, looking at our supply and demand strategy. I'm going to share a new decision matrix where we're going to talk about how we use it. But before I do that, let's talk about a couple more points here. Just because there's a seasonal pattern doesn't mean we're going to blindly buy or sell. Seasonality is merely an additional zone qualifier, and although it is quite a powerful one, we still use our supply and demand strategy as the foundation of decision making. So this is how seasonality fits into the three-step process. Direction, as we know, we analyze to assess current direction or trend on the chart in higher time frame. Are we in an uptrend, downtrend, sideways trend, or anticipatory trend? Now we're going to put another layer on top here, which is seasonality. And seasonality we look at to assess additional context on the ideal direction of price we want to be positioned with. We can have a positive seasonality and a downtrend, a negative seasonality and a sideways trend, and lots of different combinations. What I want you to focus on for now is the following. The most powerful setups are when your higher time frame big picture analysis in terms of trend and location are aligned with seasonality. So uptrend, price is low and positive seasonality, or downtrend, price is high and negative seasonality. So really combining the two as opposed to looking at them isolated. So let's talk about a couple of examples here to drive home what seasonality really is. So we can go into some Forex specific examples later. The most common example is the weather, and something you have probably already done 100 times when traveling. So let me show you an example of what we would do in a real life scenario and then how we would tie this into trading. Let's say you want to go to Orlando, Florida for vacation, but you look at the seasonality of the temperature there and you say, you know what, right here, June, July, August, man, that's hot. I don't want to go during that specific time frame. I mean, I live in Dubai and I don't need to exchange heat for heat during the summer. So we're going to Florida either in January and February or November and December. It's cooler, still going to get some sun, but not too much. So here your decision making would be driven by seasonal patterns. Some other examples: what's the average rainfall each month of the year, seasonal demand for heating oil, coffee, or gasoline. Then of course, what does the seasonal demand for food, electricity, clothing, paper, home prices, copper. I mean, you can go on and on and on and look at just about anything that we can buy or sell. Now let's apply this to actual trading though. What we're going to do is look at a seasonality chart, something like this chart here. Here you can see 5 different lines, 4 of them representing price action of 1 year from January to December. So we have orange year 1, gray year 2, brown year 3, and baby blue year 4. The 5th line, the thick blue one, is the seasonal average. This line can tell you whether a specific month on average was bearish or bullish. We are going to focus on the 4-year seasonal average. And what we want to focus on are the big directional changes of price. So in this chart, we would be looking at the 4-year seasonal average for July, August, and September. This would be a negative or bearish seasonality, right? So in these months or approaching these months, we would be looking to short. So when you look at a seasonal chart, it has the months down at the bottom and then some kind of price or percentage on the y-axis there. So it is basically telling you here what has been happening on average in all those years. Did price fall or did price rally during a specific month or period of the year? And where are the big turning points? I want to go through a quick theoretical case study. This is important for your understanding on how we use this as an additional zone qualifier. Let's take a look at some seasonal probabilities. And in order to demonstrate this, we're going to use a coin flipping example. So let's just say I'm going to flip a coin 10 times in the air, and let's assume it will land 5 times on its head and 5 times on its tail. So it's like a 50-50 probability. Now, if it lands on its head, well, what if you would receive $1,000 for it? That's nice, right? But if it lands on its tail, you'll have to pay $1,000. So after 10 flips, where are we at? Well, break even. Now, how does seasonality play into this? Well, just hang on. This is where it gets very interesting. I'll give you 2 examples. We're still going to flip the coin 10 times though. That's not going to change. It's also going to land on its head 5 times and it's also going to land on its tail 5 times. So it's still a 50-50 probability. However, here's the difference when we're using seasonality properly. If the coin lands on the head, you would receive $3,000 instead of the $1,000 in the previous example. Not bad, right? But if it lands on its tail, you would still have to pay $1,000. This is because our risk to reward ratio is now at 1-to-3, similar to what we teach in the class. So after 10 flips, you'd be profitable. Now this time around, let's look at the last hypothetical example, okay? It's a hypothetical example, guys. Keep that in mind. The coin is going to land on its head now 80% of the time. In other words, you have a very high probability of the coin turning on its head. Now everything else stays the same. We still have a good risk to reward ratio combined now with a high probability of success. This means we're even more profitable than before. So KPIs are very important for us, right? Especially the risk to reward ratio, as it changes the game. However, what if we could also increase our probability of success? How could we use this in our favor? Let us look at this now and put this into context looking at this decision matrix. This is a very simple matrix, I promise. However, we're going to spend some time on this, but really stay with me here, because this is going to be extremely important in terms of scaling up your business. I've seen traders that get stuck on a certain risk size level for way too long and therefore stagnate. And most of the time, this is because of the mental game. It is not easy to scale up your business. So when we do this, there should be a process. Okay, so now listen to this. Seasonality can be a real game changer if we apply this properly. Let's start with a positive seasonality and what we cannot do. When there's a strong positive seasonality and we are in an uptrend, we should definitely not be shorting. In general, if you remember decision metrics from the prior blueprint lessons, then we could short theoretically here. This would just be a counter trend trade. However, a counter trend trade and trading against seasonality should be avoided. Also, the sideways trend is similar to the counter trend trade. Shorting here should also be avoided. Now, here's the interesting part. If we are in a downtrend, but the seasonality is positive, then we can be looking to short. However, only with additional confirmation. Here we could be using our price action set of rules, for example. Now let's move on to the other side. Looking to buy with a positive seasonality is quite simple. We can always look to buy regardless of trend. However, here's the deal. If you are trading counter trend, then we should still be looking for confirmation based on price action. A sideways trend would become a good setup with added probability, so we can just set this trade. And now this is where seasonality becomes interesting. When you're in demand in an uptrend and the product shows a positive seasonality, you can increase your risk size with X2 or X3. So if you're normally risking $100 per trade, you can now risk $200 or $300 per trade on these setups. This is how you can start scaling up your business, and while you're scaling up, you ensure you're picking powerful trades with a high probability of success, and thereby you're getting used to trading with more capital. This is, however, an advanced rule and should only be applied and incorporated once you are already profitable. If you're not profitable, there's also no point of increasing risk size for certain trade setups, right? That should make sense. Also, when you do scale up your business and increase your risk per trade, you generally want to do this with one of these high probability trades. We call this a all stars aligned trade setup. This doesn't happen very often, so when it does, we want to capitalize on it. Alright, let's talk about negative seasonality for a bit. Basically, it is going to be the same principle, but let's talk this through formally. I can be a buyer even during a negative seasonality, because higher time frame context is usually stronger than seasonality isolated. However, here I would look for additional confirmation and even wait until the negative seasonality has passed to enter the trade. Here we would be using price action once again. So let's move over to the supply side. I can always be a seller with negative seasonality, just like I can always be a buyer with positive seasonality. What changes is the style of entry and the risk size per trade. So with an uptrend, basically a counter trend trade, I can still short during negative seasonality. However, I would recommend waiting for price action reversals for added probability. Shorting in a sideways trend becomes a normal trade setup here again. And at last, this is again going to be your bread and butter. When price is in supply and there's a downtrend with negative seasonality, all stars are aligned, and therefore this would be a high probability trade setup. Here we can increase our risk size by X2 or X3 depending on your progress and trading experience. Okay everyone, we've covered quite a lot of groundwork here on seasonality. This is going to be your base. I hope you're still with me, because now we're going to change gears and go into the specific Forex topics, starting with the Mexican peso. Yes, you've heard me correctly. Believe it or not, but the Mexican peso is extremely seasonal. Let me first explain these charts, as they're the ones we are working with. They reflect seasonal patterns for individual futures markets over the period of a calendar year. Each market is represented by its nearby contract until rollover. Each of the charts exhibits three seasonal patterns: the most recent 5 years, the blue dotted line, the most recent 15 years, the dotted red line, and up to the last 40 years, the solid black line, depending on how long the contract has actually traded, so the 40 years pattern can vary. Seasonal patterns are displayed against a numerical index from 0 to 100, the right-hand vertical scale. The graph reaching 0 represents the seasonal low, the time of the year when prices are the most consistently low, and the graph at 100 represents the seasonal high when prices are most consistently high, so a seasonal high. The months on the top are the respective contract months that are being traded for a particular market in a particular time period. Don't worry too much about contract expiry and futures terms. This is something Bern explains very well in the 2020 futures course. What you need to be aware of is that the currency charts are always displayed with the major currency as the base currency and the US dollar as the quote currency. So for the markets like USD CAD, USD Mexican peso or USD Japanese yen, we would just interpret the inverse. So a seasonal high on the Mexican futures peso chart here would represent a seasonal low for the Forex USD Mexican peso. So let us look at the Mexican peso, really focusing on the turning points. Now the biggest turning point I can spot here is from mid-July, where there's a seasonal top all the way down to December with a seasonal low. A nicer longer term negative seasonality on Mexican peso right here. So when we transfer this to the chart, we would be looking at a positive seasonality as we're trading the inverse USD Mexican peso. Also note that buying USD Mexican peso comes with high rollover cost. So if you're trading large sums, it is definitely recommended to trade futures contracts, as you would not be paying any rollover. Now look at this chart. It doesn't get much better than this. Beautiful seasonality from mid-July to the end of the year. In the past 6 years, this worked all but once in 2019. The Mexican peso works so well because of the clear longer-term higher time frame trend. We can see consecutive higher highs and higher lows across the board. So now price has made a higher high on the weekly chart and created some quality weekly demand just below. And our job is simply looking to buy using our supply and demand set of rules within this positive seasonal pattern. The Mexican peso also has a very powerful presidential election year seasonality. Now, I'm not talking about the US presidential elections, I'm talking about Mexican presidential election seasonality. I know the next presidential election in Mexico is only in 2024, but this is definitely something worth noting, and I even remember seeing this move back in 2018. This is a chart that comes straight from the CEO of Bank of America in Mexico. Definitely an institutional participant we would want to follow here, right? Really, what the seasonality says is to buy USD Mexican peso in April, sell it just 2 weeks prior to the election date, which is in July, and then short it for a couple of months. And this is where the carry trade also comes back into play. Shorting USD Mexican peso, we make quite a lot of money just with rollover. So let's look at the July 2018 presidential election. In April, we could see the seasonal low of USD Mexican peso, after which price rallied by approximately 16% in just over 2 months. And then price dropped by more than 13% just past the election. And of course, all of this happened within higher quality, higher time frame supply and demand. Even back in July 2012, we could observe the same price action. April as a seasonal low, we look to buy. June, or just 2 weeks prior to the election date, we see a seasonal high, meaning we would look to close our long and go short. And price drops for a very, very long time. And here is where the carry trade is very interesting. We could have held this back in 2012 all the way until September 2013, really trailing our stop loss based on higher time frame supply, meaning we could have earned rollover every single day for 1.5 years. Let's move on to crude oil and the Canadian dollar, the loonie. Here we will be putting it all together, commodity correlations and seasonality. Forex seasonality works best when combined with our economic indicators, crude oil and gold. So here you can see crude oil seasonality on the left, and they are really two powerful seasonal trends when it comes to oil. From January to May, there's a very powerful positive seasonality, but we can see that this is not in line with the Canadian dollar. But from October to December, we can see a powerful negative seasonality in both charts, crude oil and Canadian dollar. This is where Forex seasonality is interesting. Oil seasonality you will also learn in more detail in the futures course. Here, let us focus on the Canadian dollar. Again, note that in the Forex space, the USD CAD is the inverse. So here we would be looking at a positive seasonality. Look at this right here. In the past 6 years, this seasonality works every time but once, and that was last year. But also note that we may not find a high quality entry every time, like for example in 2016. So in this case, we also do not have a trade on our hands, right? Also note that we got some nice moves in 2017 and 2018 and potentially today. So looking at crude oil and the USD CAD during the same time windows, what you can see here is that seasonality, just like any strategy, does not work all the time. It's all about increased probability. So in 2016 and 2017, the seasonality didn't work looking at seasonality isolated. So our job is to really combine supply and demand, commodity correlations and seasonality to find the best setups. Just like in 2018, where USD CAD was in higher quality weekly demand with a weekly uptrend, and crude oil was in a higher quality weekly supply, all happening at the same time. Bingo! We can see a nice drop in crude oil and a nice rally on the USD CAD. This brings us to today. Look at this. We're looking at a window of opportunity here, and it looks like both markets are synced as we speak. USD CAD coming from a high quality weekly demand and crude oil from a high quality weekly supply. So what do we want to do? Exactly, we want to buy USD CAD. So let's look at that for a second. This table is what we provide you with every single month through our newsfeed. It shows you the seasonal trades for the months. In this example, September 2020. In the first column, you have the market that has a seasonal pattern and whether it's a buy or a sell. In the next column, you have the exact date when seasonality kicks in. Then you have the ideal date when to exit your position. So seasonality ends around that date. And then you have also the winning percentage derived from the winning years and the losing years based on the past 15 years. So look at this right here. Crude oil and the Canadian dollar with a negative seasonality, a sell seasonality. Entry date around beginning of September. Just like the chart we looked at before. Again, it is important to note that USD CAD is the inverse of the Canadian dollar. So a sell here would imply a buy on the USD CAD. Also, let's speak about the dates. The entry date does not mean we have to engage in a trade on that exact date. This is just for us a ballpark date. And of course, we would enter based on our blueprint set of rules. Also, the exit date is only an indication for us. We don't just close our position on that date. We follow our supply and demand rules, look for an opposing zone where we expect price to turn, or we use as a reversal price action pattern to exit the trade. But we could potentially even hold this position longer or for a shorter period of time. Again, all depends of our primary analysis tool, supply and demand. Now look at the probability of crude oil, 80%, in Canadian dollar, 87% during that seasonality window of opportunity, over 80% of probability. So during that time window, these markets were dropping 12 and 13 times out of the last 15 years. Pretty solid in my books. And look here, what a coincidence. USD CAD in September going into a high quality daily level on top of level inside a weekly demand zone, and crude oil is also in a weekly and daily wider version of high quality supply. Do you see what we're doing here, guys? We really start connecting the dots of supply and demand, commodity correlations and seasonality. For everyone who's been following our live trading sessions lately should also be positioned here on the USD CAD long. And now our job is done. Set and forget and get alive. And let's see how far price can travel. Also note, we should not be trading both trade setups. This should make sense by now, right? We have to choose one, as we would just be multiplying our risk if we traded both. In this case, the USD CAD was just a better setup and filled us first. But bottom line here is that these are the trades we have to take as professional traders, regardless of what the actual outcome is going to be. I don't know yet if that's going to be a winner. When I look at that course a month from now or 2 months from now, this could be a loser or a break-even trade. But the point is, we followed all our blueprint rules and have added probability with commodity correlations as a zone qualifier and seasonality of 87% on the loonie. These are the trades that we patiently have to wait for every year, and there are several of these throughout the year. We just have to wait for the right window of opportunity when we have both strategies aligned. Bingo, high quality trades with potentially amazing profit margin. Now I know it's been a long lesson, but please stay with me because this is my personal favorite seasonality to trade. We call this the gold and silver January seasonality. Also what we traded successfully in the beginning of this year. There's a positive seasonality that begins just around December, sometimes even prior to that, like in November. This is a major turning point, and from there price rallies into a seasonal top in February and sometimes even all the way until April. So here's gold, and you can see that this seasonality works very well. Again, not all the time, but most of the time. And it works even better when you have an uptrend, like we do have since 2019 with 2 higher time frame higher lows. Now again, the entries and exits of course vary depending on supply and demand and not the dates. But you can see that in most cases, there was a pretty nice rally in those months. Silver is very similar of course due to the positive correlation, but the silver seasonality usually only lasts until February as opposed to April for gold. Now also keep in mind here that seasonality works best when combined with the ideal direction. Price has been in a higher time frame downtrend all the way until 2019. And therefore, although we can see some nice moves in silver during these times, we can expect much bigger moves when silver is now turning into a confirmed uptrend. So you learned in a previous lesson that the next long trade is going to be key for silver, right? Yes, silver to gold ratio, silver catching up to gold and outperforming gold and all of that. So the next long should be timed around the end of the year, beginning of December, or maybe already in November. We should be seeing a seasonal low. And if price by then is in a high quality weekly and monthly demand, voila, we have another potentially powerful trade on our hands. What about the USD JPY and the Aussie? We know they're historically correlated with gold, so they may also be interesting during the same window of opportunity. When we look at those currencies, we want to make sure that when we map those currencies to the January gold seasonality, that they are synced. In 2019, There was a long period of time where the Aussie and gold were detached, and Aussie really being in a downtrend. So here we wouldn't have even looked at a potential seasonal long trade on the Aussie because the Aussie was in a downtrend and gold was in an uptrend. So the choice on which to trade here was simple. We just traded gold. But here's the interesting dynamics. When gold and Aussie are synced like they were from 2016 to 2018, you could also see the January gold seasonality apply to the Aussie chart. This is what you can see here. Aussie dollar from 2016 to 2018 and price making a seasonal low in and around January and a seasonal high in and around February. In general, at this point, we have to pick our poison, as I like to call it. We cannot trade all three products at once during January. In other words, we cannot trade the Aussie, gold and silver all at the same time in January. If we did, we would just be multiplying our risk. However, what we could do is create a January long portfolio and dividing our planned risk size into the three products. Let's summarize what we've just talked about. We don't just trade seasonality blindly. We align both strategies, supply and demand, and seasonality. Forex seasonality works best when combined with our economic indicators, crude oil and gold, and using correlations. This is how we increase our probability tremendously and also get the highest profit margins possible because we're able to time the market. In the world of futures, there are a lot more awesome seasonality patterns we can use, which Bernd really covers in more detail in the futures course. Combining these strategies will help you to become a consistent, profitable trader and also a full-time trader if that's your goal. Alright everyone, this was really a long but very exciting lesson for me as well. As you're seeing, we're now becoming cross-asset market traders. Seasonality can help us massively when navigating the markets. I will catch you all for the next lesson. Thanks everyone, and until then, happy and safe trading and ciao.